So when it comes to doing journal entries for bonds, one type of entry that you need to do is often at the issuance. So what entry you need to do for a bond when it is issued. So this example, this is a premium bond. We did that in our last video. So at the issuance, so which will be February 1st, 2024, the entry will be the company will get the cash, so debit cash, and they will get this amount, this one, 103,807.73, and then credit bond payable. The other type of entry that you might be asked to do is maybe we'll do the entry for the first interest payment. So that will be August 1st, 24. And the entry will be debit interest expense. And for August 1st, your interest expense will be here. So this amount, 2076.15. We will pay cash. So credit cash. The actual interest payment, the cash payment, will be this amount, $3,000. And the difference between the debit and credit, which is this amount, 923.85, here, this one, will be a debit to bond payable. So 923.85. And here's the logic to this. So cash, we obviously crediting it because we have given cash $3,000. And then we are debiting the interest expense because that is the expense that we are incurring here, 2076.15. And then we see this difference, this 923.85, it gets added to the bond's carrying value. And then what it does is it reduces bond's carrying value. That means the bond liability goes down, and our liabilities go down when we debit them. So the difference gets debited to bond payable. Another type of entry that you may be asked to do is, so let's say this company's fiscal year end. So for this company, fiscal year end is December 31st. So you might be asked to do, let's say, an entry on December 31st, 2024. So December 31st, 2024. Now, why we need to do this entry is because of accrual accounting. So because our fiscal year end is ending on December 31st, and then we see our, after August 1st, 2024, the next payment is on February 1st, 2025. So if we do not do an entry, we won't be able to cover off the period from August 1st to December 31st. So from August till December 31st, that is August, September, October, November, and December. That is 5 months. So for 5 months, what we are going to do is we're going to look at this row. because that is the time period between, because that covers the time period between, because December 31st comes between these two dates, August 1st, 2024 and February 1st, 2025. So on December 31st, what we need to do is we need to record the interest expense for 5 months. So we'll say debit interest expense, and that will be this amount. So this is the 6-month amount, right? Because from August till February 1st, that is 6 months. But we only need to cover off up until December, and from August 1st to December 31st, that is 5 months. So what we do is we take here 2057.68, we divide it by 6, which will give us the amount for 1 month, and then we multiply it by 5. This comes out to be 1714.73. So our interest expense will be 1714.73. Then, because at this point, at December 31st, we are not paying any cash, we will make the payment on February 1st, 2025. We need to accrue the interest payable. We have accrued the interest expense. We need to now record the corresponding liability for that interest that is to be paid on February 1st. So we credit interest payable, and that amount will be, so the actual cash that we have to pay is $3,000. So we take, this is for 6 months, again we divide it by 6, multiply it by 5 to get the 5 months amount. So 3,000 divided by 6, that is 500, and 500 times 5 is 2,500. So the interest that is payable as at December 31st, 2024 is 2,500. And then the difference again goes to bond payable. Again, you can take the difference between this amount, and this amount, or you can take this amount, divide it by 6, multiplied by 5. And that comes out to be 785.27, and your entry balances. So what I have found over the years is this entry is where most people struggle. So again, the first entry we did was at the issuance of the bond, which is simple. We got the cash and now we have a liability that we have to pay in future these people $103,000, almost $104,000. And then on August 1st, we make the first interest payment. So we said debit interest expense, which will be coming from this column, interest expense column. So we got 2076.15. And then we do a credit to cash because we paid the $3,000 cash. And then the difference between the two, which is here, 923.85, it goes to bond payable because that reduces our liability. Then, so remember, company's fiscal year end was from January 1st to December 31st. So from bond was issued on February 1st, and then we made the first payment on, so again, the bond was issued on February 1st, so that entry covers that thing. Then from February 1st to August 1st, the interest expense and the cash payment and the reduction to the liability, that gets recorded here. Now, the next thing is the company's fiscal year end is December 31st, but the next payment is on February 1st, 2025. So that means from August 1st to December 31st, we need to do an entry that would cover off those 5 months. If we wait till February 1st and do this full entry, this one, that will be inaccurate because this is taking us into the next fiscal year. We need to, because we will close our fiscal year end on December 31st, we need to do this entry, which covers the 5 months. We need an entry that needs to cover the 5 months from August 1st to December 31st. So what we do is we know this thing is for the 6 months from August to February. We just say, let's just take 5 months out of it and record them in fiscal year 2024. So here it is. We say the interest expense, similar to this entry, this one, is this amount, but this is for 6 months. So we divide it by 6 here and then multiply by 5 to get the 5 months amount. And then we know we have to pay this much cash in interest. So we divide this by 6, multiplied by 5 to get our interest payable liability as at December 31st. And then the difference is what goes to our bond payable. Now the next entry is, let's say, so what entry are we going to do on February 1st, 2025 then? So at this point, we will record a credit to cash, obviously, because now we are making the actual payment, which will be the $3,000 interest payment. We will, because we have paid off this liability, so we need to get rid of that. So we will say debit interest payable. Let me take this over here. 2,500. Then 1 month's interest expense. So debit interest expense. This is the interest expense for the month of January. So this will be the remaining amount from 2057.68 minus 1714.73, which is equal to 342.95, and then the remaining 1 month difference to the bond payable. Remember here we took 785.27. This was 5 months amount from 942.32. So the remaining difference goes to debit bond payable, which will be 157.05. And this is how you do the journal entries for bonds. In this example, I did for the one which was the premium bond. I might do another one for a discount bond in a future video.